Welcome to the BOGART Effect, a wealthy wisdom podcast. The following BOGART Effect podcast is intended for general information purposes only. The information discussed is no substitute for personalized investment advice from BOGART or another investment professional. Please see important disclosure information at the end of the presentation. Welcome to the BOGART Effect. I've got Patrick with me today, and we want to talk a little bit about real estate as part of a diversified portfolio. Thanks for joining me again, Patrick.
Thank you, James.
So to get started, we've got a lot of clients that ask us about real estate, not only for investing purposes, but also talking about their personal real estate holdings and how that should be thought of or fit into just not only their investment profile, but also I would say their risk profile. Right?
Mm-hmm.
An overall net worth association. Mm-hmm. So let's talk a little bit about, at first about primary homes, primary residences. I mean, the thing is we all need a place to live. And there's different schools of thought on, do I count that as part of my asset base? Do I count that as part of my portfolio or holdings? Why don't you chime in a little bit here?
Good question and good opening kind of place to start for us, because the reality is most families in the U.S., the majority of their net worth is in a primary residence.
Correct.
And in a way, when people think about investing in real estate, they don't always think about your home. The equity you have in your home is an asset. I mean, you could turn around, and sell it and other things like that. So when we're looking at a balance sheet, when we're looking at a financial plan and sizing up a net worth, we always have to consider the home equity. When we're thinking about how that relates to your investment portfolio, we need to make sure there's not a ton of overlap. If your investment portfolio is all real estate and your primary home is a big part of your balance sheet, you're 100% exposed to the real estate market. That may be your preference, it may not, but I would find a lot of times in client conversations when we talk about investing in real estate in their portfolios, it's often overlooked that they have exposure through their primary residence.
And as you were talking, there was something that kind of triggered me, but we actually have a lot of clients who even ask the question of, should I even buy a home versus just rent? Mm-hmm. And maybe it's a little tangent off of what we were going to talk about today, but truthfully, I actually think it's a productive conversation when you're talking about real estate as regards to the portfolio, because that equity is opportunity cost too, right? Like the equity that someone has in their home could otherwise be invested. It could otherwise be in money markets. It could otherwise be in different places. I still come back to the fundamental point that you have to have somewhere to live, right? And dependent upon circumstances, it may or may not make a lot of sense to have a large percentage of your net worth locked into a piece of real estate. And the reason I'm going down this pathway is because a lot of our clients are asking this about their children, more so than themselves. But I would say point blank, for someone's primary residence, if there's still a high probability that they're going to move or be transient because of jobs, because of life events, whatever, I really don't want to see a large percentage of their net worth locked into a piece of real estate. So
can we add on to that real quick?
Please.
Most common phrase you'll hear amongst real estate for people renting, they're throwing their money away. It is a myth in a lot of different ways. And you hit on the one thing, knowing your timeline. In our last podcast I did with you, James, we talked a lot about timeline. As it relates to the stock market and investing, the longer you invest, you have a greater chance of positive return. Real estate, what people often neglect is when you have a mortgage, when you finance or leverage your property. When those first payments come in, the majority of it's going to interest. Those first couple years that you're in a home, almost all that money is going to the bank. You're really not building equity in the home.
Unless the home's going up.
So now the only way that you're really making out on the other side of that is appreciation. And we've seen homes coming out of the pandemic climb dramatically, not saying they can't go higher from here. But that's something to consider is how long do you think you're going to be in a place? We often get the question from, in that exact scenario, should my kids buy a condo? Well, it's like, well, how long do you think they'll be in the condo? Oh, 24 months. It's like the closing costs to get in, the money you're going to pay in interest. That isn't always as well thought of when evaluating, is this a good business decision? Now, some people may say to us, I don't like to rent. I don't like to have a landlord. I want to have more control over my living situation. totally different discussion.
Absolutely.
But if we're just talking the financials, time horizon in the home really matters.
Well, and related to that time horizon comment, transaction costs are very real, right?
Yes.
It's usually 6% roughly for commissions, another 2% on average for transaction costs associated with it. So let's just say, for example, you're buying a $500,000 house, which candidly in Northern Virginia, that's on the lower end of the spectrum.
Yeah.
But nationwide, it's a great house. But my point is that if you're only going to be in and out of that property in, let's just say 24 months, you're exposed to that 8% in transaction costs. So then it becomes a conversation of what really is the timeline. Now, I understand the job situation can change, circumstances can change, right? And I'm not necessarily advocating one way or the other, but really want to educate on what is the risk associated with doing something like that. So perfect segue to talk about second homes, because we got a lot of clients that talk to us about second homes. And I always think it's really, really important to recognize, is that second home an investment property or is it a use asset? And I think a lot of times it gets very convoluted. My general guidance is anybody who's buying a second home with the direct purpose of renting it and using that rental income to offset the cost structure needs to be very cautious, because there's a lot of things that can happen with renting homes out. For example, you could have a bad rental market. And if that was economically what you built into the P&L to be able to afford the property, that's dangerous, right? We absolutely shouldn't be doing it. So my point is that if you have a second home or you're buying a second home, make sure you're doing it with your own ability to afford that second home. If you are able to bring in some supplemental income off of it, that's gravy. But I generally find that ends up not being the case. Someone buys a second home, they might say, oh, I'm going to rent it for this peak season and that'll cover the cost of it for the year. What ends up happening is they want to use it and in that peak time, and then they don't end up having any of the level of rental income that they were originally budgeting, and it's counterproductive, if you will.
Second homes are a huge one, and with so much equity in a lot of people's primary homes from appreciation these past few years, we've seen significant rise in capital markets. So a lot of people are getting to positions where second homes are becoming a bigger and bigger thought. And you hit on the perfect note. Is it a use asset or is it an investment asset? Yep. Is there money coming into your pocket or are you putting money into the property? And that's a big key distinction. We work with a lot of retirees. When you think about a retirement plan, what are the expenses for that second home? This is one of the things that I think we can help kind of size up, because it's very common to say principal and interest is X.
Yep.
I can do that. But then you don't think about how much furniture costs and all properties, all of the other things associated.
Maintenance, HOAs.
Yep. And that's something to really have a discussion with your financial planner to say, hey, I want to stress test my financial plan with the second home. We need to be making sure that we're really stress testing it and not just saying, well, you can afford the P&I, because that's not really affording a second home.
Yep. Great point. I think it's important to emphasize there are more costs than just the mortgage or just the cost of owning the home, and making sure that we're genuinely appreciating the carry costs. Another one, just while we're talking about it, that I think is underappreciated is the cost to get there, right? And is it somewhere that you're flying to or is it somewhere that you're driving to, right? But regardless, there is cost to get there. And then even throwing into it, if it's a retirement home, and let's just say you buy a home in a very attractive area that you want your kids and grandkids to come to, are you paying for your kids and grandkids? Because a lot of our clients, they say, no, the kids are on their own or the kids are doing well. Well, more often than not, they end up paying for the cost to get the kids and the grandkids to come visit. It's very, very common. Let's transition a little bit and let's talk about like true bona fide rental properties. And this can be different shapes and flavors. We've got clients with all walks of life here. It could be commercial. It could be residential. So it could be, you buy a home and you let's just say it's a residential home. You turn it into a rental property. Let's talk a little bit about opportunities and risks associated with that.
Great question. Well, investing in real estate is an incredibly powerful tool. Commercial, residential, a lot of it, I would say we have to measure what I would call your return on hassle. and quantifying what that ends up being. And that's really where rental properties come into play. The primary source is the rental income itself. You know, there's some tax benefits we'll talk about in a little bit in terms of depreciation, but really understanding, okay, what is the market that I can get on rent? And what are things like vacancy? Do we have a building or a place that people are going to want to come to your place and they're going to be chomping at the bit to get there? So you know when one tenant leaves, you can immediately put someone else in. Or are you going to have a period of a couple months? All of these things need to be factored in to size up, is this investment worth the hassle? Because one of the things that I think gets talked about in financial media a ton is, well, rental incomes are passive. Rental incomes, you just buy it, someone pays you, you make money. And we both know that that's very far from the truth. It's not always that easy. And even for the folks that they pay someone to be the property manager, you still own the property. You still have to be involved. And that's where I come up with this return on hassle. Is the money you're making on the property enough that it is worth your emotional and not only emotional, but physical time into this property to make it worth your while? Well,
and I'm going to come back to the comment I made earlier about primary residences, but there still is opportunity cost associated with the equity that goes into these. The general guidance that I tend to give clients is I want a 6% return on my equity. So if you buy $1 million property, and let's say you take a $500,000 mortgage, so you got $500,000 of equity, that means that $500 of equity needs to be yielding me as the investor a net $30,000 a year return. Because otherwise, I could turn around and take that money and even in a less risk profile, put it in money markets right now and get 4% plus with no risk, no work, no hassle, right? And so this is where I think it gets often underappreciated. What is the return on the equity that's in that property? And truthfully, even if you decided not to have a mortgage, right? You put all of it, it's the same math, right? Now it's $60,000 of net return because that money could be invested otherwise elsewhere. And I love the return on hassle because that couldn't be truer. I was actually my own landlord for a piece of property that I had that we were using for when I went to Texas. And the thing is goodness, I had in a period of 6 weeks, had to replace an HVAC, had to replace a water heater, had to replace a roof. There's a lot of hassle that goes into having rental properties. And some people, they don't have the time to be able to manage it. They need a property manager. That eats into the net return. Or I love these beach rentals, right? Where, sure, rent rates are high right now in the post-pandemic era. Who knows what they're going to actually do. But once you factor in maintenance, once you factor in marketing, property manager, fixing things, replacing furniture, we have a client of ours, very dear client, that has multiple of these properties. And the return is nowhere near this 6% number. Like it's a 3% or 3.5%. Well, I'm going to argue if you look at what the portfolios have done over the last 5 to 10 years, significantly better in that regards. Now, that said, I don't want to just bash real estate, right? Because when it comes down to the largest wealth creation mechanism that we've ever seen has been real estate.
Absolutely.
Right? And I think a lot of it comes back to you can use that passive income to offset the cost structure. It's almost a forced savings vehicle, right?
Yes.
You can, and it's by no means set it and forget it, right? Because, if you think about your primary residence, you're paying down your mortgage, so you're building up some equity. And of course, as you mentioned earlier, early on that mortgage is mostly interest payments, but you get towards the later years, now you're actually paying a very significant amount towards the principal. And you're building net worth, right? And it's the same with real estate investing. If you're buying, whether it be commercial or residential and just letting it go, you're building a net worth by paying down whatever the debt facility is. But ultimately, I would still say, it's one that does require effort. And that's why I love your hassle comment.
And I thank you for clarifying. We've seen, our clients be tremendously successful in real estate and not only investing in real estate, but accumulating different assets that in a lot of ways become a generational wealth for the family units. And really, we say these things today not to scare people out of investing in real estate whatsoever, but to act as a way to make sure that the regret minimization is to the highest we can get it. Understand, before you buy that beach house, we want to make sure that you understand what's the ripple effect of you getting into that? And if you're good with that, you're going to love having a beach house.
Well,
if you underestimate it, that's where you get into it and you're like, oh man, what is going on?
At one point, my wife and I had a beach house in Delaware. And, I think about the family memories. They were fantastic, but the utilization started to get diminished. And for me personally, like I'm okay with the use asset, but I fully appreciate that there's a declining amortization associated with use. And the financial side of me, of course, I think about, all right, the number of days that I'm there, like by the cost of the place. I'm like, all right, I'm not willing to have all of the equity that I have locked up into it with a declining use return, right? And in that regard, and related to that, surprise expense.
Yep.
And it gets to a point where it's like, you know what? I'm okay not having it. I'd rather rent in that example, right? Now, that said, one of the big positives of real estate is the ability to depreciate a rental property.
Yep.
And I do not want to make light of this because you have the ability to own a piece of property and depreciate it down, right? And depending upon whether it's commercial or residential, there's different schedules. But the point is that you have the ability to then get a tax benefit associated with owning said real estate. That's, my opinion, probably one of the most attractive elements to it. Not to mention, it is a bona fide business where you can then use expense profiles or things that you're having to spend related to maintaining, owning, operating, traveling to as part of this business to then be able to use. Now, it's still passive income for the record, but you're able to use that to offset against those expenses to offset against the rental income that's coming in. So for example, you use the beach house example, but if you have to drive out there to it to go see it and maintain it, well, that's a bona fide business expense. The commuting cost, mileage, and you can depreciate some of the mileage in the vehicle, et cetera, right? Like there is tax benefits associated with owning some of this real estate. And
for the tax benefits, they get really complex really fast. And in order to make sure that you're on top of that, we advise everybody, you have to keep really good records and be able to, if you're going to take something off on a return, you got to be able to back it up.
Well, and related to that, let's emphasize the financials, right? And whether it's a QuickBooks or some type of component to be able to keep financial records, having all of the ins and outs associated with the expense profile, that needs to be meticulously done. And I would also advocate for a really good CPA partner as well if you're doing real estate investing. So let's talk a little bit about REITs. What is a REIT?
So a REIT is essentially a kind of pooled investment vehicle where people are bringing together money, and then that vehicle's buying real estate.
Well, so it stands. Let's start with it stands
real
for
estate investment.
It stands for Real Estate Investment Trust. Yeah.
So let me back up a little bit. But yes, effectively at a very simple level, right? You're bringing together money to take investments into, whether it could be all sorts of different things. It could be a REIT that focuses on assisted living homes. It could be a REIT that focuses on commercial real estate. It could have a certain, geographical preference. And it gives you economies of scale as an investor to have access to things that maybe you might not have been able to buy into a commercial real estate building. With the exception of having access to a REIT. So to recap and simplify it, a REIT is a pooled investment vehicle into a real estate piece of property, commercial, residential, et cetera, right? And the thing with REITs is nice is you can have the ownership experience from that passive income point of view, which, by the way, most of these REITs are paying really nice yields, right? Let's not ignore that. I would also add that the nice part about REITs is that you can get some diversification. So you're not just buying one piece of property, right? Tell me a little bit more. What else is pros, cons, negatives? So you hit on the big one, and that is essentially you're getting true real estate exposure without having to be the CEO of that real estate investment itself. So that's number one. Number two, the yield that you're getting on REITs is typically at the higher end of the spectrum in terms of yields available. That being said, just because it has a high yield doesn't mean it's always the best investment. And there is an element of the market value. And when we look at REITs that are publicly traded, they can lose value. And
actually, real quick, I'm sorry to interrupt you, but with REITs, you do have two types. There's publicly traded REITs, and there are private REITs that are not publicly traded. And there's a meaningful difference in the liquidity. So publicly traded REIT is exactly that, right? You push a button, get out of the position all at once. but you also have private REITs, which are relatively illiquid. And I'm not going to say less transparency because that is not it, but they're not marked to market every single day. And because of that, there's not going to have the same level of fluctuation.
Right.
However, you do not have the same level of liquidity either. Right.
And let's talk about that a little bit in terms of the mark to market. With REITs, you have to remember at your core, you're still investing in real estate. And you wouldn't take your primary home and every hour of the trading window say, well, my primary home at 9:45 in the morning was worth $1 million and now it's worth $1 million and a couple cents by noon. You got to take a step back. It's different than investing in a stock or REIT, a public REIT is. And one of the benefits, for private REITs is that there is an element of, hey, we're not going to value this every minute of every day in trading, and that tends to favor long-term investors in terms of the mindset. But it's important to remember, a real estate investment trust that's publicly traded is still real estate, and it shouldn't be something that's being day traded.
Correct. I love that. I would add one of the bigger negatives too is most REITs have what are called K1s.
That's a big one.
What is a K1? Why is that a bad thing?
So a K1 is a special tax document, essentially kind of noting your partnership interest. And K1s, they're a big one for your taxes. They can delay your taxes. It can be more expensive in terms of filing cost. Oftentimes, K1s are issued at a delay because they have to themselves reconcile these private investments. So we'll hear clients tell us, hey, I had a K1 in a real estate investment. I have to do an extension on my taxes because I don't have my K1 yet. They have every other document. Their W-2s, their the K1's always the straggler. So it brings into question sometimes if you're going to invest in a private real estate fund that's going to have a K1 where there is an added administrative hassle, you have to invest a dollar amount that justifies that. So,
great point.
If you're gonna do a private real estate, we're not saying invest as much as you have. Size up with your financial advisor, but no, private real estate trusts are not 1099, which is a publicly traded REITs tax form, which is pretty common, very simple. The K1 is an added complexity that should be factored in terms of, do you want to make this investment? And if you have questions on that or how that impacts your taxes, definitely talk to your advisor, definitely talk to your CPA to get their counsel on that, because it is a big surprise for a lot of folks. Especially
the first year. And then the frustration or hassle factor of how late these K1s can come in successive years, it's can be very frustrating. So how can we integrate this real estate conversation with market cycles and talking about the place for real estate within someone's portfolio?
So it's really interesting because when you think about, there is a level of correlation between the U.S. stock market and the U.S. real estate market. Typically, when one's moving in tandem, you don't typically see the other one doing the complete opposite. But they are different, though. If you were to take last year, real estate cooled off now that mortgage rates have climbed a lot. The stock market did really well last year. And so it's not always a one-to-one lockstep. But real estate is very, very, very influenced by how the consumer's doing, what your financing costs are. And ultimately, it's a supply and demand business. You have to have supply. You have to have demand. That creates this equilibrium. Right now, we don't have a ton of supply in the market across the U.S. It's made a tough environment for buyers.
And I would throw in high interest rates have also
yes, very high interest rates where financing cost a few years ago on $1 million home are multiples higher than what they are today.
It is all relative because in the 80s, you're getting 17, 18% mortgages, right?
Yes.
Here we're in the 6s and 7s now.
And absolutely. And so for folks that are thinking about investing in real estate, keeping a longer term focus in mind is incredibly important, and acknowledging, hey, there's periods where interest rates were 18. If you're going to buy a home, I don't know if the difference between a 6.5% mortgage and a 5.75, in my opinion, probably shouldn't be the reason you're getting into a home.
Correct.
It should be, do you want to own the asset? Is this something that you want to live in or rent, or if you're going to do an investment? Don't let interest rates drive the full discussion. You have to have a long-term focus. Is where I'm buying going to be a nice place that is going to appreciate in value over time? If you have an investment component, can you get renters? What's the occupancy rates look like in comparable places? That long-term focus, you're really investing not only in a building itself, in a plot of land, in a community. Those cycles take very long periods to play out. Take the, right outside Washington, D.C. If you were to take Arlington, Virginia 25 years ago versus today, completely different. Certain neighborhoods are built up today that even 5 years ago were not quite built up. And we've seen real estate prices adjust accordingly. So investing in real estate requires that long-term view, that long-term prediction. On the flip side of that, there are periods in the market where you can be opportunistic. Notably, we saw 2008. There was the real estate bubble where you saw massive discounts. You saw people fire selling homes. If
foreclosures.
You have foreclosures, if you have liquidity, maybe you accelerate your timeline to buy because you're going to get a discount. If you look at the pandemic right at the onset, there was some really attractive deals at that point. And so, yes, there requires a long-term focus on, is this the neighborhood, the home, the plot of land? Does that check a box?
Yep.
But there's also a little bit of a strategic, hey, right now it's a buyer's market and I want to participate in that. Or right now, hey, I have this place, I've held it for a while. I don't really like the upkeep. We talked about the return on hassle. Maybe you look around and say, there's no supply in my neighborhood. I'm going to be the one that goes first, and then you get out. And so you have to overlay that. And this is where having a financial team helps tremendously. You talked earlier about the CPA, having a real estate agent guide you on the nuances of, well, in this shopping center, you're going to get this, that's going to help you. And then on the back end, having your financial planner be the quarterback saying, okay, well, if we do this with your real estate asset, what's the ripple effect? How does that impact your taxes, your long-term wealth? How does it ultimately change the family?
And I think related to that, right, is this the percentage that we want within our portfolio? Does it make sense to necessarily maintain this property for a multifamily type of, generational type of wealth? How do 1031 exchanges interlay with this? Like, real estate also has the ability to be, as we've already said, very tax sensitive associated with it. But you have the ability to use, for example, tax nuances like a 1031 exchange, where you're able to then move into without having to realize the gains and move into another property that might be more appropriate for a rental perspective. The thing that I would say that also gets understated is real estate is an asset class where you can actually leverage relatively easy. And what we mean by that is you can borrow, right, and buy real estate. And you can borrow up to a certain percentage of whatever the property is. Most of the time it's 60%. Sometimes you can find lenders that'll go a little bit higher than that. But you can borrow for a investment purpose where it's all part of the operating cost. I still come back to this conversation around risk, right? And making sure that you truly understand what the risk of that leverage is. You truly understand that with real estate, you can theoretically see it go to zero, right? And I think that gets understated sometimes because there are lots of people use 2008 as a great example where the boom was happening, right? And they're taking a lot of leverage and they're getting these adjustable rate mortgages that were 12 months long. Some they don't really have a lot of those anymore, by the way. Now they're 5 to 7 years. But the point is getting these adjustable rate mortgages with these hyper low interest rates for a finite period of time. Then all of a sudden the rates reset and they're completely underwater on the property, and boom, we're upside down real fast. So understanding how that fits into the total portfolio structure, right? Let's kind of talk just in conclusion around key considerations when adding real estate to the portfolio. Understanding, cash flows, appreciation, risk diversification.
Yep. So at its core, there's really two ways that you make money on real estate. This is overly simplified, but very important to keep in mind. You're either cash flowing the property through rental income, or someone's helping pay the mortgage, someone's paying you a little bit maybe on top of that. That's number one. You're getting some sort of yield. You can get it through a public REIT, private REIT. You're getting it through your own rental property. Cash flow is number one. Number two is the appreciation. It's often an overlooked aspect of the rental property when you're potentially sizing up or buying any real estate asset. So is the property going to appreciate in value from what you paid for it? And if you're renting it, are you going to be able to generate cash flow from that? Now, there's a lot of things that go into a good cash flow property. But in terms of return, those are two things that really matter. One of the things you talked about earlier, I want to include on this, though, is if we're looking at the numbers, those are the two things you need to focus on the most, as well as quantify the risks. The risk list is probably a lot longer than the upside risks. I have clients that will tell me, though, we talked about the return on hassle, you talked about 6%. They'll say, listen, my grandkids, I want them to be a part of my life. I want them to come visit me. I know my current primary home, wherever it is, that might not be the most fun place. I know they'll come visit me at the beach. And we'll walk through the numbers, and they may not make a lot on the property. And they may come back and say, it's not about the cash flow or the appreciation. It's about the fact that I'm not going to, really get hit to the chin a ton, but it's that my grandkids are going to come spend time with me. It's my kids are going to come spend time with me. That use value,
right? And that use value sometimes is non-quantifiable, right? And I think about the time I mentioned at our beach house, right? The time I spent with my kids, those memories are there forever. Right? It's just, I could get the same conversation with renting versus ownership in that regard, right?
And that's, you have to use a little bit of feel, but this is where I think of a good financial advisor can really help, again, map out that ripple effect of, okay, we know you want to get into real estate because of whether it be grandkids, return, cash, whatever. Let's understand, are we going to be able to get there in an ideal world? But if the market goes sideways, interest rates go up, housing market comes down, have we thought and planned for the contingencies so we, again, minimize regret in getting into one of these properties? Because it's not always as easy as selling a stock and you're in and out if you don't like it. The process to make change is very involved.
Absolutely. Patrick, thank you for the time today. This was a great conversation. Appreciate you taking the time to listen.
Thank you.
The previous presentation by Bogart Wealth was intended for general information purposes only. No portion of the presentation serves as the receipt of or as a substitute for personalized investment advice from Bogart Wealth or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy or any other non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation, or prove successful. Neither Bogart Wealth's investment advisor registration status nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Bogart Wealth is neither a law firm nor accounting firm, and no portion of its services shall be construed as legal or accounting advice. No portion of the podcast content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Copies of Bogart Wealth's current written disclosure brochure and Form CRS discussing our advisory services and fees are available upon request or at www.bogartwealth.com.